Probably the question I get asked more than any other is, how can I make money with stocks?
To know, buy, sell, high, low, bears, bulls.
Well, there's actually two primary ways that people do that. They do so through appreciation and corporations giving money back to shareholders, either directly via dividends or indirectly through stock buybacks. Let's dive in. Welcome back, you amazing 18,000 subscribers. Let's get straight into this one. Of the two primary ways people make money in stocks, appreciation is the one that I get the most excited about and where I believe the most opportunity lies. Over the last 100 or so years, give or take, the stock market has gone up by nearly 10% per year. Of course, you all know that that's not a guarantee about the future, but to put that into perspective, if your grandfather had invested $100 in the market 100 years ago, it'd be worth, wait for it, about $1.4 million today. $100 to $1.4 million. That's the power of compounding. That growth has happened because the stocks of the companies that make up the market have increased in value by that much on average. So over a long period of time, perhaps that'd be a reasonable expectation for you and the money you're investing. But there's no guarantee as to what the next decade or decades holds for investors, let alone the next year. There are periods of time where the market just keeps climbing and seems like it can't stop. And there are also periods of devastation where the market just keeps falling and no one wants to touch it with a 10-foot pole. And there are periods where the market is just kind of sideways and frankly boring for everyday investors with just broad exposure. Allow me to walk you through some specifics from history. Here's how the stock market has performed every year since 1928. You see some years with massive losses and some with incredible gains. The best year saw a gain of almost 54%. While the worst year, a loss of over 38%. But most investors in the market plan to invest for more than just a year. So let's look at the 10-year annualized returns of an investment in the stock market starting at every year since 1928. That is to say, if you invested in 1928, what average return would you have realized if you had left your money in the market untouched for the following 10 years? As you can see, some decades have been pretty flat, and some have been booming. For example, if you had invested in the market in 1949 and then never touched your investment for the next 10 years, your account would have realized a 17.9% annualized return. That's without accounting for any sort of fees or anything, but still, that's amazing. But if you had invested in 1999, coincidentally the year I bought my first stock, and left it alone for the following decade, which I did, you would have realized an average annual return of negative 3.8%. That sounds about right. And again, that's before fees. In all, more than 30% of those 10-year periods resulted in returns of less than 4%, a number that might not be too exciting if you were counting on that 10% historical average that everyone talks about. But if we expand that holding period even further, from 10 years to 40 years, the market has returned anywhere from 4.2% to 8.8%. So if you're planning to make money by investing in the market in general, it's really a long-term play. And honestly, one that usually doesn't work out for most investors who try. They end up making way less than the market does, but that's the subject for a different time. In fact, the first 6 myths of stop investing like they tell you are spent really fleshing out that phenomenon. And if you're here, taking the time to actually invest in your stock market education, I'm assuming the potential for a 4, 5, or 6% annualized return over the next 4 decades isn't getting you super excited anyway. Don't worry, it doesn't get me excited either. If that was all that was possible here, I wouldn't have made a career out of it. Not to mention the fact that those returns are only going to happen if history repeats itself, which is not guaranteed. We've talked about market and economic cycles in other videos, but suffice it to say right now that when you understand those, I think you too will have your doubts that the next 40-year period might not even achieve that 4 to 9% range we just explored. This is one of the reasons that individual stocks are so attractive. No matter what the broader market is doing, there will always be individual stocks that are outperforming. And if you can learn to identify solid stocks, buy them when their price is low, and then sell them when their price is high.
Buy low, sell high, that's my motto.
Then you'll have the tools to outperform no matter what the broader market is doing. And you'll have the potential to realize much greater annual returns on average.
Buy low, sell high.
That's definitely not easy. It'll take time and experience in the market to really master this, but it is absolutely possible. And that's precisely what we try to teach here on this channel and in our private community. Let me show you a quick clip from a video I put together for Ryan Scribner's YouTube channel a while back. This clip discusses two examples of investors who have been able to profit from their intimate understanding of how stocks work. Check it out. I want to give you a couple examples of what can happen when you understand this concept. Joel Greenblatt managed a hedge fund that focused on smaller cap companies. Throughout the decade, starting in 1985, his average annual return was around 50% per year. But as his fund got large and he became more restricted, he had a decision to make. In an interview with Jack Schwager in Hedge Fund Market Wizards, he reveals that his performance over the following decade was similar. Another example, one that you are likely very familiar with, is Warren Buffett's. Look at his performance in his early years when the assets he managed were smaller and he was able to invest in smaller companies. There you go. You can see what's possible here. Joel Greenblatt averaged greater than 40% per year over that 20-year period by investing in highly researched individual stocks. Warren Buffett, for 3 decades, from 1970 through 2000, averaged more than 25%. Finally, another example not mentioned in that video is the legendary mutual fund manager Peter Lynch. While managing a massive fund, due to his understanding of stocks and the research required, he was able to realize an average annual return of 29% over his 13-year tenure from 1977 through 1990. So you can see what's possible when you take the time to learn and understand what you're doing here. But that's all just one way that you can make money in the stock market. It's exciting, and I tend to spend a lot of my time there. But the second way is through the company giving money back to its shareholders. That can happen through buybacks, which I've talked about in other videos, or what we're going to focus on here, dividends. The goal of any company is to maximize shareholder value. Some companies do that by reinvesting in their future growth. Think Amazon, Google, Facebook. They believe, and most shareholders agree, that they'll be able to provide the most value to investors by reinvesting in their company with the idea of generating even greater profits in the future. Other companies, however, often older companies, don't have as much room to grow and decide that the best way to provide value to their shareholders is by paying them a share of some of the company's profits. They do this through dividends. For example, Coca-Cola, at the time of this recording, pays a dividend of 44 cents each quarter. That means that if they were able to make that payment for a full year, they'd be paying each investor $1.76 for each share they own. Since you could buy Coke today for $63 per share, that $1.76 dividend payout would represent a return of about 2.8% per year. Dividends provide another way for you to make money in the stock market. You still have to know what you're looking for, though. You can't just base your investment decision on which company is paying out the highest dividend yield, for example. In fact, that's often a recipe for disaster. But I hope this has helped you see the potential opportunity that exists in the stock market and answers the question of how can I make money with stocks? If you can learn to assess a stock for its value, growth opportunity, and or dividend quality, you'll have the potential to consistently make money in the stock market. Let me know in the comments what excites you the most about making money with stocks. Is it a particular strategy? Is it the potential that you see? I hope you'll take a second to let me know. And if you're interested in learning more about diving deep into stocks, you'll probably enjoy and learn a ton from these deep dive videos. And if you're interested in learning more about our private community, you'll find all the details here. I can't wait to get to know you better. I wish you all the best. Take care.